Okay, our final speaker this morning will be Jerry Wright. Jerry was instrumental in founding the United Potato Growers of America while serving as CEO of United Potato Growers of Idaho in 2005. As a Capper-Volstead cooperative, UPGA has successfully focused on assisting potato growers in the largest potato growing regions of the U.S. to manage their production to meet demand. During Wright's prior tenure as CEO of UPGA, he helped organize member United cooperatives in Washington, Oregon, Colorado, California, and Wisconsin, as well as to encourage the organization of the United Potato Growers of Canada. Since that time, UPGA has grown to include local cooperatives in other producing regions. Wright focused his full-time efforts as CEO of the United Potato Growers of Idaho from 2006 to 2009, helping members achieve 4 years of stability and profitability. He returned as the president and CEO of UPGA in December of 2011. Jerry holds a Bachelor of Science and Master of Business degrees from Brigham Young University. His career spans more than 30 years of extensive branded consumer products marketing at companies including General Mills, H.J. Heinz, and ConAgra Foods. Please welcome Jerry Wright.
Well, what a great meeting we've had so far. We've learned a lot. And I think each presentation has built upon the other to help us get a broader picture of the economics of potatoes. It's interesting as we listen to Haven's speech, which I thought was excellent, and talking about what the future is going to look like. There's no question that technology has improved all of our lives in the potato industry. Indeed, as he forecasts, I would agree that technology is going to lower the economic risk of, or shall we say, the growing risk associated with growing potatoes. But that's not the only risk in growing potatoes. There is a huge economic risk associated with growing potatoes that we have to cope with and we have to grapple with. And part of the discussion today really has to deal with the economic risk that we face in the coming year. And so while we'd love to have technology solve the growing risk, the economic risk is up to us. And as yields go up, as the trend line over the last 50 years without GMO continues to go up. When you add GMO, okay, that will propel this thing perhaps for another 50 years of increased yields. We have to grapple with declining consumption and as one of the fundamental issues we have. So, as a prelude, let's look at what's actually happening in the markets today, and this is for fresh. And this is based on AC Nielsen data, and the most current period is right before the Thanksgiving holidays and Christmas. So this is through 11/21 of 2015. And got lots of numbers, so let me give you some headlines, okay? First, we're looking at 52 weeks trends and 13-week trends. And the first headline is, total category pounds and dollars continue to decline. 2.3% in pounds. I don't pay that much attention to dollars, I'm looking at pounds. So total category pounds on a 13-week basis and on a 52-week basis continue to decline. Very concerning. Second, if you look at the three big items we've got, russet potatoes, red potatoes, and yellow potatoes. Russet potatoes down 2.8% and is that a 1.4 or a 4.4? I can see it over here. 4.4%. Very concerning. Even concerning is red potatoes on a 52-week basis and on a 13-week basis. I call that flat. Now, reds have been growing for 4 or 5 years in a row. Every meeting we've been in, We've been talking about the growth in red and yellow potatoes. Well, reds are flat, and that's the first time in at least 4 years. Yellow potatoes continue to grow, and so they're the highlight. You see a lot of other specialty stuff, very, very, very small part of the category volume. 95% of all the volume is in these three varieties, and 85% is in russets that continue to decline. Very big concern that we have to grapple with. Okay? Second, take a look at the size, what's happening on a size basis, and here's some headlines, okay? First, this is on a 52-week basis, total potatoes. You take a look on a 52-week basis at the average retail prices, down across every variety. Okay, what's that saying? These are the average retails per unit. The price at retail has been going down 4 or 5%, in total 1.9%. Yet what you see on the pounds is total pounds down, and you see across varieties, take 5-pound russets, 10-pound russets are the vast majority of russets, 5-pound reds and 5-pound yellows, and you see 5-pound russets and 10-pound russets down in volume. You see reds down in volume in spite of retail price declines. Now that defies what you and I would have expected. We would have expected if prices go down, we would expect to see volume at least stable or going up, and we're not seeing that. Quite concerning to me. And as I said, in those key items, and that's why I put those up there, these items represent 85% of all the volume in the entire fresh category. And you take a look at each one of them, and they're down with the price going down. Very concerning, okay? Next, let's take a look on a 13-week basis, same story, doesn't change. So you go back and you say, well, what's happening? Maybe it's that promotions aren't working. And here's some key data on promotions, okay? So here's the same sizes, okay? And you see a couple of things. First, you take a look at promotion activity. This is the latest 13 weeks. I didn't do 52 weeks because it just aggregates too much together. So in the last quarter, here's what you've got. You've got percent of the volume sold on promotion, and this is per AC Nielsen. You see red virtually all the way down. So we're selling less on deal. In the yellow bar is the number of weeks in the quarter, in the 13 weeks that they were on deal. This really concerns me. You take a look. Russet 5-pound potatoes were on deal. I'll say this. They were on deal 100% of the time. When we sold them at wholesale, we sold everything at a discount, did we not? Okay? And as a matter of fact, during that time period, we sold everything with a 10% decline or a 10% discount versus prior years. But what's the performance? And this now is not the holidays. This is August, September, and October time period. Call it back to school. What you see is russets actually in store were promoted only 3 weeks out of 13. And everything else, less than 1 week, with the exception of reds, 2.2 weeks. What does that mean? That means the consumer saw 1.5 to 2.5 weeks worth of reduced prices, and then the prices went right back up to everyday retail prices. Even though we sold all 100% of the volume to the retailer at a discount, they only passed it along 2 weeks time period, and they pocketed the rest. Now that's a theme that you see happening throughout this industry all the time. And what was the impact? Okay, only less than a third of the russet 5-pound volume, it was actually sold to consumers with a promotion. 100% of it that we sold was with promotion. Did I click that? 100% that we sold was with promotion, but only a third of what consumers bought, they bought with a promotion. And that is the highest on the list. As you take a look at there, that's the highest on the list. Everything else is 20%. And as a matter of fact, of all of the potatoes, that's almost 90% of all the volume, only 20% of it was sold to consumers at a discount. Retail trade took the rest. Now take a look at it by call it package type. Anything in a bag, down on a 52-week basis, down 2.8%. What's growing? Specialty stuff, single wrap, tray, and fresh cut. Take a look at fresh cut. That's got some innate in there. At least that's what I was told by the Nielsen people. So it's the specialty stuff that's actually showing some interest. Traditional in a bag down. And here's even more interesting. Total traditional potatoes, that's reds, yellows, and brown potatoes in 5-pound and 10-pound bags, down 2.9% in pounds and 5% in dollars, and that's on a 52-week basis. So of great interest is that things like petites represent 5% of the total pounds, but 12% of the dollars. So the workhorses that we have declining, but petite, specialty, and even organic growing. Of interest, you hear a lot of people talk about organic. The USPB talks a lot about organic. Reality is, organic is only 1.7% of the total category volume, okay? And basically growing, but very slow, okay? Growing in terms of percentage points, up 28%, but off of the extremely small base, 3.2% of the dollars. I found it really interesting that petite potatoes, those are C and D size potatoes, they represent 5% of the total category, 3 times more than organic, and 4 times more in terms of dollars. So, what are the key conclusions? Despite the lower wholesale prices that we've given, everyday pricing has remained flat, and trade promotion price reductions in store were less than last year, and they've been less effective in moving volume. That is a huge concern all of us should have. Second, declines continue heaviest in russet varieties. Reds for the first time showing no growth, and has to do with the retail pricing from what I can see. And yellows continue steady growth even at significantly higher retail pricing. The only growth seems to be coming in specialty items, and it's off of a very, very small base. So the flagship continues to be gaining water and slowly sinking in front of us. Petites now represent 5% of the category, organics 1.7% of the category. So that's a look from an AC Nielsen retail perspective. What does the United data and combined with USDA tell us? Okay. Last year in North America, including Canada, we shipped 103 million hundredweight of fresh potatoes into the industry. And there you see them broken down by state, okay, or by key growing region, with Idaho shipping the largest amount, 35 million, and sort of an emerging new area, okay, combined of San Luis Valley, Northeast Colorado, Nebraska, New Mexico, Kansas, and Northwest Texas, okay, that area being the second largest shipping area of potatoes now for us at 23 million, okay? And what kind of returns did we get last year? Okay. virtually across the marketplace, but especially in the higher producing areas, at best break even, and in some and in the Idaho and Pacific Northwest area below cost of production. Well, this year has promise, okay? Estimated this year we should ship 98 million hundredweight, okay? Down 5.6. That is very positive. And even more positive is that all of the reduction came in Idaho, okay, 4.4. Now, lest we think that that was actually a strategic decision, it was not. They planted the same number of acres. Mother Nature just turned around and gave them less yield. But we have a tendency to look at this thing and say, gee, we're down 5.6 million hundredweight. We are short. Take that out of your vocabulary. The industry is not short. The windfall Mother Nature gave us in the form of that less reduction has just brought the production basically in line with the demand. For the first time in 5 years, we're actually balanced. We're not short. If you take a look specifically at the russet category, you see that this year declines in the russet category bode well. 70% of all the shipments, you see it's gone from 74% of category sales continually declining. If we ship what we say we're going to ship this year, we'll be down to 70%. So russets continue to become, while still the major part of our category, increasingly other varieties are picking up their slack. And as you graphically display this, if you take this 68 million hundredweight of potatoes and array it based upon the last 5-year weekly historical patterns, the blue line shows you where balanced supply is. Green bars show you what's already been shipped. Blue bars here show you what's to be shipped. What I look at is where do the blue bars come in relationship to this heavy blue line? And you see a lot of space. What it basically says is, compared to historical price positive, or call it price balanced periods, we've got fewer russet potatoes in the last half of this year than the demand would require. All of that bodes very well for the second half of the year. Those of you that are actual shippers in the room go, this doesn't make sense to me. If we've got a balanced russet crop for the first time in years, why doesn't it feel like that from a pricing standpoint? Wouldn't you agree? Doesn't feel like that at all, does it? Okay, there's a reason. Okay, if you take a look, these are shipments right through Christmas time period. Okay, and they're shipments where we go back and we look at seasonally what should be shipped. If Idaho has 29 or 30 million hundredweight, and they ship them according to the same seasonal patterns that they always have historically, are they ahead or behind? And the reality is, San Luis Valley is shipping the crop that they have today slower during the first 4 months of the year. Idaho, on the other hand, is shipping the crop that they have faster. As a matter of fact, if you break that down, probably 800,000 of it happened in the months of August and September, right out of the field. But clearly 400 or 500,000 of it has happened since October. And clearly it means that Idaho, even though it looks like they had the lower yields and a smaller crop, they're shipping it faster than they would normally seasonally. Now, in the last 3 weeks, that's slowed down pretty significantly, and prices are starting to reflect. But indeed, that's a factor that we all need to take a look at, okay? Another key thing, Columbia Basin down, and that was a strategy on their part. They planted fewer acres and then got a slightly less than trend line yield. So that's really part of a strategy. Once again, I'd say this. This wasn't part of a strategy in terms of their production. It's just the way it happened. This was part of a Columbia Basin strategy. And then the big challenge is Wisconsin. Wisconsin had one of the biggest crops they've had in years and years. But they also are slightly behind on a seasonal basis. So I think the reason it doesn't feel like we've got a balanced crop today is principally because the largest shipping region is shipping the crop at a faster rate than the 31 million hundredweight that they have. They're shipping it at probably closer to a 33 million shipment rate, and I think the marketplace, that's what they're seeing and that's what they're responding to. Last talk about russets. Pay less attention on the total numbers. You see that we are down, okay, on the total russets. I put in red all the areas that have cut back, and in green are the areas that increased, okay? And for the most part, you see everybody had a tough year. Nebraska intentionally cut back. Idaho didn't, but Mother Nature cut them back. And here, New Mexico intentionally cut back. And interestingly, Texas, a significant player lately, intentionally cut back. They intentionally cut acres. So on the other hand, we got increases, 19% in Maine. That wasn't because they planted more acres. It's because some of the processed potatoes are being pushed into the fresh category. And finally, Wisconsin and Canada both blessed with higher yields, as we've already heard. Let's look at reds. Here's what's happening to the reds. As I said, if I could have extended this graph 2 or 3 more years this way, you would have seen 4 or 5 years of steady growth, flat, and now for the first year decline. And that decline is really coming principally by a change in Florida, where a significant number of acres have gone out of red production. All of that means, as you graph out these 15 million hundredweight, 1 million less than last year, as you graph it out based on the historical patterns, you take a look and you see, wow, look at all of that area there. In the next coming weeks, this is Red River Valley mainly, and Wisconsin. There's room for them to move some of those potatoes because there's those acres in Florida that are not going to be put into production. There's room to move some of those potatoes that way and do a better job marketing. Take a look at all the areas that are down in red production, with the exception of Wisconsin, up 24%. That's the big yield they got. And Canada, that's also the big yield they got. But significant change in Florida. The big deal in Florida, 500,000 hundredweight gone out of production. Yellows is the star, but of concern, you have 4 or 5 years of growth, flat. And the real question is, does it start to mimic this? There's a real possibility it is. And so even in yellows, my message is proceed with caution. Because next year, if we come back with 500,000 more, this market could be flattening out. You see the graph doesn't give you much. You see the graph with the increase shows we're going to ship more yellows in the last half of this year than we did the prior year. The yellow bar, the yellow shaded area in the back is last year. So we're going to test it and see if the market will take them. And once again, you see mostly green here, everybody increasing their yellow production. So about a year ago, we got interested in what's really happening at retail and promotions, and went back and had AC Nielsen analyze 2.5 years worth of historical data. All potato SKUs in 18,000 stores in over 25 markets. So if you think about what's been gone on during those 2.5 years, in at least some of those stores, every kind of promotion condition has existed and consumers had a chance to respond to it. And so AC Nielsen went back and analyzed the data to say, what kind of response did we get? What's the optimal pricing point for 10-pound russet potatoes? And what happens to the volume when we increase the pricing point or lower the pricing point, okay? And so and we analyzed russet potatoes, 5-pound and 10-pound, and we analyzed 5-pound red potatoes and 5-pound yellow potatoes. And even went back and mixed and matched them and said and they came back with enough data to be able to create some models and some predictive models. And so this one right here is total U.S. non-holiday 10-pound russets and 5-pound russets. And so this is what happens to 10-pound russets when you put them on deal at different price points. Here's what happens to the sales. And here's how they interact with 5-pound russets. Very fascinating. As I analyzed it, here's what I found. I just took this chart and turned it into numbers. It actually was more helpful to me to turn it into numbers. Here's what it showed. 38% of the stores, call them, it's not technically right, but 38% of the stores, shall we say, have 10-pound russets. They sell them for $3.90. And at $3.90 price point, here's the velocity. Don't even worry what the velocity in units are. Just look at the raw numbers. That's the velocity in per point of all commodity volume. Okay? And when they're selling them for $2.90 a bag, the velocity goes up. In fact, it goes up 84.8%, or about 8.5 percentage points for every dime the retail price changes. Also of interest is when they sell them for $1.90, the velocity increases, but not nearly at the rate that the velocity increases between $3.90 and $2.90. Only 35% or 3.5% for every dime that they change the retail price. And most fascinating is, if they price 10-pound russets below $1.90 a bag, it doesn't change the velocity at all. Doesn't change the velocity at all. So you go back and you say, well, what were they doing? In the latest 13 weeks, the price was $3.67 for 10-pound russets, and when they put it on deal for 1.7 weeks, only out of the 13 weeks, they dropped the price from $3.67 to $2.91. So I went back and I said, I wonder what that cost them. I wonder how that worked out financially. And there it is, a theoretical 1,000 units of movement at $3.67, assuming the retailer's getting at least 50% margin, he makes $1.84, okay? Retailer, by the way, is making more money on potatoes than you guys are. And he puts it, and so he takes the price and drops it for $2.91 for 1.7 weeks, and he got 64.5%. And by the way, this is all empirical. This isn't made up. This is actual what happens in the stores. And so when he drops the price to $2.91, he gets a 64.5% increase in volume. You say, wow, that's a windfall. I wonder how much money he made at it. Yeah, he made about $1,000 more on the extra units, but his margin dropped to 34%. Would it surprise you that the retailer says, I'm not going to do that unless you lower the price? But what is it that we do? We lower the price not just for 1.7 weeks. We lowered for the entire 13 weeks. In fact, we lowered it for the entire year, didn't we, Ed? Or I said Ed. I'm sorry, now I'm drawing a blank. We lowered it for almost the entire year, didn't we? Okay? And so the bottom line is the retailers, and I did this on 5-pound russets, 5-pound reds, 5-pound yellows. Same in every one. Not as dramatic as on 10-pounders, but same strategy each time. You get an increase in volume. You definitely get an increase in volume when you put it on deal. No question about it. But the increase in volume doesn't pay the retailer back the margin that he loses, and so he has to get subsidized. So bottom line, retailers know the sweet spot for consumer movement. Does it surprise anybody that the retailer doesn't move the retail price around? We change the wholesale price just because of our supply, but retailer doesn't change his retail price. He knows where the sweet spot is to maximize his return. And he knows where the sweet spot is so that when he puts it on a temporary price reduction, he maximizes the velocity that he gets out of it. So he's smarter at this, and he's making money at it. In the last 5 years, your wholesale pricing changes have had almost no bearing at all on what he's selling at retail. No bearing at all. So if we're frustrated that we're seeing 2% declines in consumption, it's because the retailer says, hey, you know what? I don't care that much. I got to make my margin. He's in the business to make money. The retailer is going to make his 50 points of margin no matter what. And he isn't concerned about the declining consumption. Retailers, in fact, have used the lower wholesale pricing to increase their everyday margins. When you go back and look at what we gave back in wholesale price, $2 to $3, he didn't change the retail price. So every day in those last 13 weeks, if he had 3 weeks on the 5-pound russet size where he had it temporarily reduced in store, for the other 10 weeks, he made a killing. He made 60-65% margin on all of those potatoes. And that's, frankly, how he paid for the temporary price reduction. He says, yeah, I'll take a 34% margin in those weeks because I'm going to make 65 or 70% margin in the out weeks. So, I guess the question is, should we be upset? I guess the question, can we get mad at the retailer? Can we get upset with the retailer because he wants to make 50% margin? Can we get upset with him if he says, you guys want me to lower the price, I can't make it up on volume, somebody's got to subsidize that margin? No, we can't be upset with the retailer. He's doing what we do if we had a chance. Should we be upset with the shippers? Well, that's what we pay them to do. We pay them to move the volume, don't we? And they're sure trying to move the volume, especially when we give them more supply than they need. They've only got one thing to do. That is, let's go out and lower the price, see if we can increase the volume. The reality is, nothing changes until the supply changes. Nothing will change. Retailers are going to make their margins, and your shippers are going to continue to try to move the volume. Growers always pay for oversupply, always. The grower is giving away all of his margin. In the last 3 or 4 years, you've given away all of your margin for the privilege of growing potatoes. How does it feel? So maybe the right question is, if that's the way the world's going to be, how do I win at this game? In these oversupplied markets, there is a way to survive. First, you have to understand, you have to truly understand the markets themselves. You have to have reliable data, and that's what we've endeavored to bring to you, is reliable data that really is fact-based. And then you got to use it. And the facts are, these days, you're not going to walk in and convince people to radically change. You've got to become the low-cost producer. So how do you become the low-cost producer? Remember, nothing changes until supply changes, and growers always pay for oversupply. And so the question is, how much do you want to give up of your margin for the privilege of growing potatoes? Well, how do you become the low-cost producer? Darn sure you don't do it by planting more acres. That sounds back-asswards, doesn't it? Wait a minute. I'm going to become the low-cost producer in a category that's already oversupplied, and I'm going to do it by increasing the supply. I think somebody on the other side, deity must agree. Okay? I said truth. Well, there is a way. There is a way to balance. Oh, does that mean he took it back? I'm sorry. There is a way. Come by to the booth. There is a way. We have it on a jump drive. There's a way for you to rationally balance your supply and still become the low-cost producer. Okay? It's empirically already figured out. It was done by the University of Idaho. It is documented through and through. It's available. We have it available at our booth. Please stop by. We'd be glad to explain it to you. But there is a rational way to approach these markets. We just have to do it. So now the big question is, what does it look like next year? Drum roll, the reason everybody stuck around to hear all this. Okay? First, what you've heard in these meetings today is the commodity outlook in 2015 is not positive at all. You take a look at where wheat is and where barley is and where alfalfa and corn are today compared to last year, and all of a sudden, potatoes at below cost of production are looking like the best horse in the glue factory. Right? Say, it ain't pretty, but it's better than the rest. And so, in that kind of an environment, working together with North American Potato Market News, we've looked at multiple scenarios and using econometric models, not guessing, not using a Ouija board, but looking at the history, the econometric models that have taken the last 25 years of commodity prices and potato acres and regress that to try to find the correlations. What those models say is a couple of things. Number one, if nothing else, you have to plan for a return to trendline yields in all areas. I think a year ago, Stuart Liddell from Rabo was here, and he made a statement. He said, the trend line yield in potatoes is the most predictable trend increase in agriculture. That's what he said. So you got to plan that we're going to go back to trend line yields first. And second, because of the commodity prices, the models say there's a very high probability range on increased acres. So here's what we've done. We've gone back, and that's kind of blurry. Is there a way to make that clearer? Oh, well, I think we want it to be blurry, don't we? Okay, so let's take a look. What the models say today, and this is not a prediction. What this is what the statistical models are forecasting based upon the current economic conditions and the outlook on the other commodities. And what the model says is the highest probability right now is there will be a 2% increase in acres next year. That's across North America. Okay? And on top of that, if we go down and come back from, we were at a yield of, what was it, about 419, Bruce, last year? 418? Okay, so we're not even on the chart. If we come back to a trend line yield, what that trend line says is the same thing that Haven was saying, and that is you need to expect, you need to plan that yields are going to go up, and Mother Nature is not going to change this puppy. And that's got built into it now a 3 or 4% increase, 431. And you take a look and see where those intersect, and the GRI that gets predicted mathematically out of these models is about $4.15. That's high probability that's going to happen. You don't like that forecast? Pick your own. You say, I don't think we're going to have a 431 yield. I think we're going to have less of a yield. We may have a 425 yield. Oh, we'll go to 478 if we've got a 2% increase in acres. So you see, under any scenario, with a 2% increase in acres, we are in the in the $4 to $5 range. Now, if you go back to your cost of production, which we've done in Wisconsin, we've done it in Colorado, we've got it in Idaho, we've got it in Washington State. You go back to your cost of production last year, and the operating cost, the direct production costs of potatoes was $5.25. So if the industry does what the model says, and that is 2% increase in acres, there isn't a scenario where you're going to get back even the direct cost of production. That's all of the variable costs associated with producing potatoes, no contribution to any of your fixed, just all your direct costs. And if you want to make a contribution just to your potato fixed, not to any other overhead, just to your potato fixed cost, you throw another dollar on there. So to get another dollar, you got to have about 6.25 next year to make a contribution to your potato fixed cost and to cover all of your variable costs. Where does that end up? 6.25, huh? 6.25. Well, it's somewhere right around in here. If we have a 1% decline in acres, and well, let's see, to go out here, it's actually, if we have a 2% decline in acres and we have trend line yield, we're going to get to an economic, call it a break even, just an economic break even. So I go back and I say, how do you survive in this environment? I realize, I understand completely that there isn't another commodity place to go. But it just is irrational. It defies logic to go out and increase plantings, because you already know what it will do is take the one commodity that was the best looking horse in the glue factory and put it right down at the bottom of the heap instead of the top of the heap. So proceed with great caution. You look at it and say, what do I think's going to happen? What are my economic plans next year? Come by the booth, and we can talk to you about ways that you can become a more efficient producer without increasing your production. But the bottom line is, next year is going to be very difficult, and I think we all need to be very, very cautious. How do you become the low-cost producer? You can't do it by planting more acres. That's for sure, not next year. Remember, nothing changes until supply changes. Nothing. And growers always pay for oversupply. How much of your margin next year do you want to give away simply for the privilege of growing potatoes? I'll take any questions. That's a glutton for punishment. He wants to applaud. Any questions? Yes. Well, thank you very, very much for coming today. Yes. Other question? Yes. I can barely. No, I can see you. That data is simply this. It's taking the actual shipments from the Eastern Idaho report, okay, going back and matching it up against 5-year trends on a weekly basis. And it, like I said, it happened very, very early in the season, and it was really the summer crop that got ahead and did the bulk of that quote unquote overshipping. Okay. So it's statistical. In other words, it's the statistics. It's in comparison to 5-year trends. And it may not be versus exactly last year. It's statistical versus, it goes back and it says, if you have 31 million hundredweight to ship in Idaho, that assumes a lower pack out than you had last year already. If you've got 31 million hundredweight, based upon the 52-week historical trends by week, here's how that 31 million would ship each week. And then it compares it against what actually shipped, and that's how it calculates. And I'm doing that from memory. I can't tell you exactly when that happened. I know, though, I have gone back and looked. The last 400 or 500,000 have happened since October 1. So my first thought, Todd, was, well, geez, has this been going on the whole time? The answer is no. And I said, well, maybe when they get into the storage crop, the dynamics change. And the reality is, since we've been into the storage crop, we're still moving it slightly faster than historical averages would say we have to move if we had 31 million. Okay? Other questions?
Gary, with 5 years of history now of below the cost of production, and this year with the potential to get, as you described, that the major areas shipping too fast to get the price up, do you predict, does your model show that we probably will see a bit of a hockey stick at the end of the season this year, and does this message all get forgotten when that happens late in the season?
The model does not predict the proverbial hockey stick. Okay? Don't want anybody to walk out of here and say there's going to be a hockey stick. Okay? What it does say, though, is that as Idaho moves back into that 31 million proper shipping range, and everybody else is going to pick up. You noticed everybody else was slightly behind. It will be very balanced, and I think you will see better pricing, and that you should see slightly better pricing in the second half of the year than you saw in the first half of the year. The GRI today is barely at that $6 level. Okay? And every area is ratioed off of that or balanced off of that based upon your geographic positioning in the country. But nobody, at best, people are barely at break even. And so I think what the models would say is that fundamentals look better in the second half than they did in the first half, but I can guarantee you this, everybody walks out of the room because they heard the word hockey stick, there will be no hockey stick. So frankly, the one thing you should plan on, there's not going to be a hockey stick. Okay. Other questions? Did I say that clear enough? Any other questions? Well, we really appreciate your attendance today. It's been a great meeting. Let me give you a few instructions. We have, what time is it here? We got 20 minutes, okay? Thank you for your attendance today, and a heartfelt thanks to all of the presenters who I think have done an excellent job and have given invaluable information. Every year this meeting really comes away and gives us the nuts and bolts that we need as we plan ahead and as we look ahead the next 9 months, and especially as we approach planting. Okay? There's still time for all of us to react to this information. As I indicated, each one of these presentations was videotaped. Okay? As soon as we get them broken into their segments, they will be on the website, and you will be able to with a click of a button, see whatever presentation you desire and be able to analyze it at your leisure. And it will be at potatobusinesssummit.com. I guess that's all one word, right, George? potatobusinesssummit.com. We'll send you an email notification if you already, when you registered, you gave us an email. We'll send you with an email notification of when they're available. If you're fearful that you did not register and you want that, please write it on a piece of paper and give it to myself or Buzz or George. And George, raise your hand back there, and Buzz, raise your hand, and we'll endeavor to get it to you. Today's luncheon will be served in the grand ballroom. So as you leave this room here, you're going to turn to your left and exit the room and follow the signs. It's here in this part of the building. It's just down the hallway. Follow the signs. It will be held in the grand ballroom, I think it is, right? All right. Following lunch at 1:30, you are invited to a seed division public briefing. Seeds become an increasingly important part of this deal, especially if you're looking at such a tough year next year. You may want to attend that seed meeting. It will be in the St. Croix A room, which is across from the Terry Factor Theater, and you're welcome to attend. The Potato Expo starts today at 1 p.m., and it will be followed by a kickoff reception today at 5:30 p.m. in the main convention center. Again, we give our great thanks to AMVAC, who have been a major supporter of this event, to the J.R. Simplot Company, to John Deere, and we also thank the breakfast and the break was provided by John Deere, and the lunch today is being provided by Simplot, Dow Chemical, and Tessenderlo-Kearley, makers of Thysol. So we thank them for their support and invite you to come back to next year's event in San Francisco. Thank you very much for coming today. Enjoy the rest of Potato Expo and have a great event.